financial markets continue to be choppy. In this first quarter, we are seeing elevated volatility and price level swings that we haven't seen for some time. Both stocks and bonds have been under pressure in recent weeks. To help put some perspective on this, we're going to zoom out of the present and take a look at the stock market going back to the 1920s. Now, speaking of the 1920s, the first Winter Olympic Games were held in Chamonix, France during the 1920s. It was January 1924 to be exact, and Charles Jewtraw of the United States was the first person to be awarded the gold medal. His sport, the 500-meter speed skate. The 500-meter speed skating event is a sprint. Tying this back to investing and wealth management, rarely do we ever find sprinting a useful strategy. Perhaps a better comparison is the 50-kilometer cross-country skiing event. It's longer term, a series of ups and downs, requires lots of planning and pacing, and adapting to the conditions. Now, the path of the stock market is oftentimes described as a series of bull and bear markets. Bull markets are generally times when prices are rising, and bear markets are defined by periods of falling prices, where the decline is 20% or more and lasts for a few months. We're going to take a look at some data next. Using this long-term chart of the US stock market, we can review the 11 bear market declines that have occurred since the 1920s. To be clear, we are not in a bear market now. However, to call out a few examples, bear markets, which here are in red, occurred in the early 1930s during the Great Depression, in the early 2000s after the technology boom and bust, and in 2008 and 2009 during the Great Financial Crisis. A key takeaway here is that when we zoom out, what becomes more apparent is that bull markets, the green lines, tend to last longer with larger gains. And bear market declines, which tend to be steeper, are shorter lived. In fact, bull markets on average tend to gain about 380% and last a little over 7 years. Bear markets, on the other hand, tend to be declines of about 39%, however, only last about 1.3 years. Now, we need to be careful of averages and not to think that time alone defines when a bull or a bear market will arrive. This is not like the Winter Olympics that occur every 4 years. Case in point, during the 1980s and 90s, we had a 25-year period with only one bear market. However, from 2000 to 2009, we experienced 2 severe market declines within a 10-year period. So what do we do with all this information? First off, the past 100 years has included a lot of events, including a depression, multiple wars, various levels of inflation and interest rates, epidemics, and a pandemic. Yet the stock market averaged about 10% per year. Second, the short term is uncertain. Predicting short-term future results is like trying to predict who's going to be standing on the Olympic podiums. Market declines do occur, and although they tend to be shorter-lived, it doesn't stop investors from going through a series of emotions. After all, we oftentimes remember the bad or painful moments more so, and when uncertainty is high, it can lead to emotionally charged decision-making. In our view, the best course of action for any market is to plan ahead and prepare to take action. At Vector, we use a bucket approach to planning and investing. Dollars needed for the short term, the next 3 years, are set aside in lower risk, more stable investments. We call this assured income. This is important, especially in markets like we're experiencing now, because the short term is uncertain and we don't want to be forced to sell long-term investments at inopportune times. Longer term, where we have time on our side, we have the opportunity to be diversified across multiple asset classes and take action when market prices are down or choppy. This longer term segment is where we look for rebalancing opportunities, effectively buying low and selling high, which can benefit portfolios when market advances return.